It kinda sounds like a bird, right? Or maybe a fish. Escrow. Perhaps it's something on a fancy restaurant menu? Well, no, but escrow is something you'll hear about on the way to achieving your dreams if you're dreaming of home ownership. And today, we're going to tell you all about it. Hi everyone, I'm Lindsay Cohen, one of the home buying experts here at Zillow. Let's talk about one of the strangest terms in the home buying process, escrow. It's not a food or a state of being. So just what is escrow? The escrow account. Well, escrow is a type of account. Most commonly, it's where critical funds in the transaction of a home are held until all of the conditions for the deal are met and the sale is finalized. Think of it like a neutral zone managed by a third party. Now, there are other types of escrow accounts, which we'll cover briefly later. But to fully explain escrow, we need to back up a little bit. What happens when a home contract is signed? Okay, so you found a home you love. You make an offer and the seller accepts it. At this point, the escrow account comes into play. Your offer will include something called earnest money, which is a percentage of the home price paid upfront in cash. This shows you're serious. Earnest money is typically 1 to 3% of the total price. Want to learn more? Check out our video about earnest money in the link below. The earnest money will eventually be applied to your down payment, but that can only happen once the sale closes. So until the deal is final, your earnest money has to go somewhere. It's not yours and it's not the seller's just yet. So where exactly does it go? It goes into the escrow account. Where does the escrow account come from? Typically, the listing agent on a home will open an escrow account once the seller has a signed contract. The account itself is often managed through a title company and an escrow agent. In some states, depending on the laws, that may be an attorney. Whoever they are, they will hold the earnest money and some other items until the deal closes. Okay, but where does that weird word come from? I'm so glad you asked. The word escrow comes from the old French word escrew, which means scrap of paper or scroll of parchment. Can you imagine buying a house today with a really long scroll of paper? Me neither. What does being in escrow mean? When you hear the phrase in escrow, it means that a home sale is on the way to being completed. The items in the escrow account may include the property deed and loan funds, along with the earnest money. All of those are being held until all conditions of the escrow arrangement have been met. Then the sale can go through and the escrow account closes, finalizing the deal. The conditions for closing usually involve receiving an appraisal, title search, and approved financing. Can you fall out of escrow? Yes. If the conditions for the deal aren't met, a home can fall out of escrow, which means the tentative deal is off. This can happen if you, as a buyer, fail to get a mortgage on time, or you choose to exercise any of the contingencies in your contract. Let's say, for example, that the inspection turns up some big, expensive surprise. If a buyer backs out of their contingency clause, their earnest money is usually returned. But if the deal falls through for other reasons, they may not get it back. What does it mean to close escrow? To close escrow means that all of the escrow conditions have been met. You've received a home loan, unless you're paying all cash, and the title has legally passed from the seller to you. During the closing process, the closing or escrow agent will disperse transaction funds to the appropriate parties, ensure all the documents are signed, and prepare a new deed naming you the homeowner. When you close escrow, it's time to celebrate. You did it. You bought a home. So maybe stop for a pizza and then start packing for your big move. The other type of escrow account. The other type of escrow account is, alas, less fun. It's also known as an impound account, and it's used by your mortgage servicer to manage property tax and insurance premium payments on your behalf. If you hear about regular escrow payments instead of just one, they're probably talking about this kind of account. Basically, this impound account ensures that the funds for taxes and insurance are available and that your premiums are paid on time. Your lender doesn't want you to miss a tax payment and risk a foreclosure on the home. They also don't want you to miss a homeowner's insurance payment. So they hold your tax and insurance payments in this account until they're needed. How do monthly escrow payments work? Your lender will notify you 30 days before your next payment if the amount changes. You can also ask your mortgage servicer to walk you through the local impound account funding schedule that applies to your loan. If there are insufficient funds in your impound account to cover the taxes and insurance, your monthly mortgage payment may increase, even though on fixed-rate loans, your principal and interest will stay the same. The initial escrow payment at closing. Lenders usually require at least 2 months' worth of insurance and property tax funds in the impound account at closing. The amount you have to prepay into an impound account for these costs is based on your location. Keep in mind, these funds aren't additional closing costs. You're prepaying extra months of home insurance and property tax bills that you'd have to pay anyway. Your mortgage servicer will list the initial escrow payment amount due at closing on your loan estimate. Your escrow analysis statement. Each month, your mortgage statement will show you how much you've accrued in your impound account. And each year, your mortgage servicer is required by law to send you an annual escrow account analysis showing your account history for the year and notifying you of any change and additional needs. Is an escrow account required? An escrow account for paying property tax and homeowners insurance is generally required by lenders who originate VA, FHA, and conventional loans. In some instances, lenders may allow the homeowner to pay the property tax and home insurance as a lump sum instead of setting up an escrow account. If you waive escrow, be aware, some lenders may charge you a fee or an increased interest rate. If you aren't required to set up an escrow account, you can open one voluntarily to break up insurance and property tax payments into smaller amounts, keep track of payment due dates, and avoid surprise bills at the end of the tax year. All right, that was a lot. Who's hungry? Seriously though, we hope this helped you feel more confident in navigating the closing and escrow process on a home. Please like and subscribe to Zillow for more content just like this, and check out the links in the description box for more tools and resources. Thanks so much for watching.